Is the Santa Claus rally getting out over its skis? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Rupert Mitchell, author of the Blind Squirrel Macro Substack. Hi, Rupert. Welcome to the show.
Good evening, Maggie. How are you?
I'm doing well. It's evening here. It's morning for you because you sit over in Australia. So
It's
we're
definitely coffee time.
coffee time. Yeah. And it's really exciting. I'm really happy to get we've got a theme going this week to get another kind of global view on what's going on. But we've got to start in the US. Big day for tech stocks here. The NASDAQ above 20,000 for the first time. Broadcom, Alphabet, Tesla all leading the way. Bitcoin above 100,000 again. So it seems like it's risk on. And we'll get to that. I want to unpack what you think about that in a minute. But since it's your first time on, why don't you give us a little bit of an intro on your background and your Substack?
Sure. Well, I started in finance in 1994. Spent 25 years in investment banking roles in London and in Asia, in Hong Kong. I've worked on in most parts of the private side of an investment bank, everything from M&A through capital markets, through corporate derivatives, through convertible bond capital markets, and things like that. So I've got a sort of a broad multi-asset skill set, and I started Blind Squirrel Macro when I moved to Australia in late 2022, post-COVID, and that's the squirrel.
Yeah, I love it. And it's fun. Your posts are really fun, but more importantly, they're really, really informative. As I said, on the global view and across so many different asset classes, which I think is so valuable because we talk a lot about diversification, but the truth is a lot of people are very heavily concentrated, especially in technology. So let's start there. What do you make of this year-end rally we're seeing, especially since it seems to be the usual suspects pushing things higher again?
There's a lot of money chasing not enough stocks at the moment, and it's you know I, it's it is a self-fulfilling sort of infinity machine to a certain extent, but it does feel like the air's pretty thin up here. Um, it wouldn't take much for a sort of scales off the eyes moment for people to realize, really, should I be paying 10 times sales for Apple, the largest company in history? Um, and Nvidia has been the story of the year, and they have made an awful lot of money and will continue to make an awful lot of money. But ultimately, it's always a stock that's at risk of derating, even if it carries on making a lot of money. So, it's tough not to be fully engaged with U.S. equities, but there will come a time when we will have some kind of regime shift where it makes sense to be a bit more diversely spread.
Yeah, and it seems like does it feel and the Santa rally over at skis is the title of one of your recent Substacks, which is why we wanted to start with that. Does it feel um how much does momentum have to do with what's happening now? Because I feel like everyone's nervous, but everyone's afraid to get out of the rally because there just is this like enormous momentum, it seems like, behind what's happening.
Well, it depends what kind of seat you're sitting in, right? If you are an institutional manager of money, it's become an existential threat to not participate in this year end, in this year end move. They have the tyranny of annual benchmarking versus the index, and if you're not in the index, and if you're not overweight the biggest winners in that index, you're going to have a very tough conversation with your bosses and your clients at year end. For those of us in the retail world, we do have the option to take a pause, take a breather. Um, Cash is the most valuable option at times like this, and you don't need to be all in here, because ultimately all you're monitoring is your net liquidation value in your account, and drawdowns are very tough to get back when they come, and this feels like a market that could put in a nasty, punchy drawdown at any time. Now, you can hedge yourself against that. Puts are as cheap as they've ever been right now, but at the same time, you can just, raise a bit of cash. It's been a great year for most people in the market. Unless you've been fighting it tooth and nail all year, you've probably had a decent year. Um, there have been parts of the market that have been miserable. I'm a curmudgeonly value investor at heart, and the value factor has been absolutely crushed so far this year. Interestingly, though, the value factors works quite well in other parts of the world. If you take China, for instance, I mean, the value factor in China and in emerging Asia has actually had an outstandingly good year.
Yeah. And it is interesting. I think you just brought up such a really, really important point because a lot of the people that come on, as you say, they're speaking from a more professional standpoint. And so their job is to be invested. That's what they get paid to do. But you're right, it's very different depending, if you're sitting retail and as hard as it is to get out when it feels like things are still moving. I mean, there is something to be said, which is why a lot of the people who come on always talk about having a framework, right? And don't be afraid to take some of those profits sometimes, especially if you feel like your risk horizon is near term and you may need that money. So I appreciate you bringing up that
Absolutely,
point.
and also let's not forget the broader picture, which is the game, right? We've just gone through the year ahead season with all of the big Wall Street banks. Now, I spent 25 years working for them. You know, I it is impossible for a Wall Street strategist to have long standing if they're not pretty much bullish most of the time. Yeah, you can be tactically bearish from time to time, but the whole complex of big retirement is based around, well, markets go up and to the right, and that you and actually that's a good starting point. Ultimately, perma bears can be perma poor if they're not careful. But at the same time, I think you need to take the process of the strategist year ahead equity target index levels with a healthy dose of salt. Ultimately, they get it wrong 9 times out of 10, and they have to be bullish. The machine doesn't, the capital markets machine needs positive momentum. So yeah, I mean, we are in one of these classic years where it seems like the mainstream Wall Street is looking for another 10 to 15% upside in U.S. equities next year, and most of the independent world is, a bit more cautious. I'm in that camp as well. It feels like pretty thin air up here.
Yeah, which is why we like to have you on because I think we need to hear that differentiated point of view. We have a question. Hi, everybody in the chat. If you're not in the chat and you want to get there, subscribe. That's how you get to be part of that fun conversation. Someone said, "Hello, beautiful people in the chat," which I appreciate. Under air. Boris has a question. Hi, Boris. Uh, and I think it's kind of related to what we're talking about. Would you see some value in moving from the market cap weighted S&P index to an equal weighted version? How are you thinking about this kind of?
Listen, it's been a really, really popular call by a number of people. I mean, there's a ticker that you can get, the equal weighted S&P, which is RSP, and there are a number of others that do the same thing. Ultimately, I think it makes a lot of sense. I think equal weighted indices actually have performed very well over long-term backtests. But, there's been no escaping how markets have been functioning for the last 4 or 5 years, where the dominance and leadership from the large cap the large cap tech stocks has just been overwhelming. Ultimately, I'm a believer in mean reversion, and I don't believe that dominance can exist forever. I mean, at a fundamental story level, actually, before we go to the story level, I think that systematically, these large cap stocks, while everyone has good jobs and 401ks, are getting God knows how many cents in the dollar of every dollar that comes into the market, and so there a sort of self-perpetuating machinery around that's supportive while the flows are supportive. So I guess that's a sort of macroeconomic call. If people start losing their jobs and 401ks are not being funded monthly, then that's going to be a headwind for market cap weighted indices, and then. Ultimately, with the large cap tech stocks, you've got a lot of hope based around artificial intelligence and the capex that's been going into those data centers and large language models, which you know hasn't got a great deal to show for itself in terms of revenues yet. Now, I'm not in the in I'm not an AI doomer in terms of the story. I'd cast myself as an AI agnostic right now. I use and love the tools. I know I'm not paying fair value for them right now, and I wonder how much I'll use them if it costs me, 10 grand a month to use Perplexity or Notebook LM from Google or Midjourney AI, all those things.
Yeah. Yeah, the economics of it are gonna be very interesting, and where the revenue comes from and how it's
Well,
paid
what's
for.
quite interesting is the latest story about sort of the rate of change in terms of progress on these models slowing down is actually, I suspect, a little bit bullish, right? If we are not in an insane run to create the God machine, then revenue is going to have a chance to catch up. If you're not just throwing men, gun, and horses at building the next bigger, faster machine, well, then some of this AI capex, that's not superb news for Nvidia, but they're still going to sell a lot of chips. But ultimately, for the hyperscalers, for the big cloud companies, they can take a bit of a breather on their capex.
Yeah, even the fundamentals can catch up. Although then, of course, there was the quantum news this week, so I'm not sure if we're gonna get that pause. AI may pause, and then it'll
I get out of my depth very quickly if you
yeah,
want to
it'll
go down
ramp
the
up. Well, we
quantum
all
rabbit
do
hole.
because it's so brand new. But let's go back to where we both get off from some terra firma. Um, so just to finish up, wrap up on U.S. stocks. One of the other themes that we heard a lot about, especially right after the election, was this big rotation that was going to come. Right, the deregulation coming from Trump was going to benefit small caps. It was the time for the Russell. Small caps and mid caps that, to that extent, had been undervalued, and we were going to see this broadening out for the market, which we did. But it seems like
I mean,
it
that
sort of
gap's
came.
been filled. The
Yeah.
post-election gap in small caps has just been completely filled back in the last 2 to 3 weeks. Um, uh, Listen, I get the arguments around deregulation and tax cuts to drive growth in small and medium-sized enterprises. I completely get that. What I am very wary about is people reaching for mid caps and small caps as an index, right? And I've written about this quite a bit in the past, which is, just be very careful that you know what you own. By definition, the Russell 2000 has a sort of inverse Darwinian feature in that the biggest winners in the Russell leave the Russell to go to the S&P. So you're sort of short a call on the best performers there. And then you've got an awful lot of companies included in the mid cap indices, which are, you know, I mean, I did a deep dive analysis a few weeks ago of, how many companies in that index were, according to sort of Altman Z scores, at a higher risk of bankruptcy. If you look at the percentage of the Russell that doesn't make profits, it's enormously high right now by historical standards. So you just got to know what you own, because it's not as directly linked to the real economy as you would like to think.
Mm.
And you've got all of these sort of structural negative features built into it. But there's no doubt that everyone has been leaning into Russell upside into year end. If you look at the open interest in call options on the IWM or the RTY, the Russell futures, everyone is leaning into that trade. And you know, Ultimately, it's been a bit disappointing post-election
Yeah, it feels like that.
after an initial flurry.
Yeah, that it feels like that. It had that great pop, and then it kind of feels like it's reverted back to what we know. I think that answers your question. No one knows thyself. He asked if the Russell was going to move back to underperforming S&P, the SPY and QQQs in 2025, and it sounds like you're skeptical about its ability
No,
to.
listen. I love value. I love value stocks generally, and which naturally brings you to small and mid cap type names. But just know what you own,
Yeah.
and ultimately it should be. it should be a stock picking world when you're in the world of small and mid caps. I don't think mid market cap weighted mid cap and small cap indices are a very good long term buy and hold
Yeah.
um, item for investor portfolios. You've got to do the
So
work on that, or find a smart mutual fund manager that's doing that work for you.
yeah, well, this is where active management
Yeah.
comes in into play. Which at some point, if you're all interested, maybe we'll get the folks from Royce back in. They're really, really long
Oh, that would be
history
great.
of Mike Green started there of being active small cap managers. So that would be interesting to hear what they say. So let's talk about where you do see opportunity, and let's widen the lens out from the U.S. Because you do think that that there are a lot of overlooked opportunities internationally. Is that correct?
Well, what's so strange is that they're already working, right? So, actually, if you look at the total return of this is numbers through to last Friday. I haven't redone the numbers for the last couple of days, but as of last Friday, um, the FXI, which is the iShares large cap China ETF, was neck and neck with the SPY, the S&P 500, on a total return basis. And when you take into account that 1/4 of the attribution for that SPY return year to date was Nvidia and Apple, which, let's face it, are not exactly geopolitical risk free. When you think where Apple makes their phones and where Nvidia makes their chips, you're not exactly protected from some kind of geopolitical malaise between the US and China. You know, actually, Chinese stocks have been working remarkably well this year. Now, there are a lot of people that you know, got sucked in the spike in October. But it's generally a pretty good idea to not buy the mania peaks, particularly when very high profile hedge fund managers are getting on TV to tell you to do it. And it's particularly not a good idea to reach for sort of Chinese tech stocks listed in the US, trading at massive premiums to equity markets in China that are closed for the annual holiday in Golden Week. But actually, if you look at just the volume at price type analysis, there weren't very many people that got caught burning their fingers at the very top. And if anyone that was positioned earlier in the summer is still looking at having pretty decent returns. But I actually think the way of staying in the trade in Asia is to target sort of more low beta type exposures. Stay away from the crazy volatility, and it'll allow you to stay in the trade and compound away. I was reading last week that one of the best performing China long only managers has got, I mean, he's up 67% on the year so far, and he's totally focused on the Hong Kong listed 8 shares of Chinese state-owned enterprises, those sort of boring, stodgy names. But you've seen excellent returns there, and these type of returns are going to feed on themselves. Ultimately, Asian and North Asian investors. You had Western on yesterday talking about the momentum style factor of Asian retail. Yeah, it's real. But once a trade's working, you're going to find more money coming in from the sidelines to follow that trade, and it'll develop momentum characteristics of its own.
Yeah, which
And
is important to note. That is an important. I guess maybe it's looking a lot like that here. It might not have been before, but the idea that there's a lot of momentum that drives it is important to keep in mind. Let me ask you a question with that the China opportunity. Is that very vulnerable to them following through on the stimulus? I mean, if you're going to think about China, do you have to believe that the government is going to be able to stimulate?
it's very interesting, right? Ultimately, theoretically, you're absolutely right. We need to see consumption growth in China. We need, I mean, if you look at the Chinese bond markets, we're seeing record low yields in the Chinese 10-year right now. The fixed income market is screaming deflation. But you've had a green light from the authorities as a Chinese investor to buy equities. And that's why some of the sort of cross signals, that's why Chinese equities are outperforming the Aussie dollar right now. That's why they're not. That's why that Chinese equities are sort of ignoring, you know, the rally in Chinese rates, because the market has been given the nod that domestic equities are a reputable asset class going forward.
So when you say given the green light, so
They want to
don't
create
go
an
buy
equity
that
culture.
house. Go ahead and put your money in the
Well, don't go and buy that second or third apartment.
put your money.
Diversify into equities, because we've given you a green light that that's a decent place to diversify your investments. And let's not forget the quantum of domestic savings in China. You're looking at $10 trillion worth of domestic savings sitting in money, well, not even money market accounts, in deposit accounts, earning 35 basis points. Right, just on the the MSCI back to the FXI, the large cap iShares, right? And you know these are inexpensive stocks. The ETF at the ETF level, you're looking at a dividend yield. Okay, that's not a coupon, but you're looking at a dividend yield of 2.25% versus 35 bips in your cash savings account.
So a couple of really important questions here. I I've got to find out who said it, but what is the squirrel's time frame? Which I think is a very good question. Uh, so when we're talking, and I think especially when we're talking about this Chinese, the
Absolutely.
opportunity in
So
China.
I have to. Well, it's slightly different. I'm 16 hours ahead of you right now, but we have a double hit. So during our winter, I need to set an alarm clock to get up pretty early to trade at all,
Mm.
right? Um, and I actually I actually consider the fact that I don't have winking numbers in front of me all day, every day, to be a considerable source of alpha. What was that movie, Squirrel? The dog being distracted by the squirrel. I don't have to deal with that.
Oh,
Um,
well, that
I,
was one of them.
I, you know, I sometimes trade tactically, but I consider myself a sort of much. I consider myself as an investor on a much longer term time frame. I
Okay, so some short-term
typically
opportunity, but when we're
three
talking
months
about
to 12 months. I think that this China EM opportunity is a multi-year opportunity with interesting entry levels here and now, right? We are dealing with a rampaging US dollar right now, but I think it's showing every sign of wanting to roll over right now. You have a new administration coming into the US who, even if they don't say it explicitly, all their policies lean on a weaker US dollar. And a weaker US dollar is really good for short duration emerging market assets. And you can buy so many high quality large cap names on high single digit dividend yields, low single digit price earnings multiples, and it's not as though those businesses are ex growth.
So, Oliver, and that question was from Mark on time frame. Thank you for that, Mark, because it's always important to ask that. Oliver, responding or making a comment, I'm old enough to remember what happens to Chinese stocks when Trump starts tweeting about tariffs and trade issues. We do have this sort of geopolitical potential change in global trade policy. Does that worry you when it comes to emerging markets, or does the dollar benefit outweigh everything?
Listen, we've all got to get used to another 4 years of tape bombs, or tweet bombs, and the only way you can deal with it is by sizing. right? I think that the asset allocation makes sense. I think that ultimately, listen, I don't really want to have a debate about how real, not real these tariffs are. I think we have to take the incoming administration at its words that it's a policy that they're wedded to. I think that tariff bomb noises could make a lot more noise around closer to home economies like Mexico and Canada than it necessarily will with China. China has diversified its trade relationships significantly since Trump won, and yes, gosh, they're not being impact free, but your starting point in terms of where these equities are being valued is just considerably lower. I mean, you can step off to the ground here, whereas whereas in U.S. equities you're at 30,000 feet without a parachute.
It's so true. One of the things that you like, if I'm not mistaken, is because you have a sort of running list of areas that you update where you're looking for acorns. Long Africa. You're interested in Africa. That seems very frontier.
It is, and you know, it's always worth looking at markets when they start closing ETFs, right? Last year saw the Egypt ETF close and the Nigeria ETF close. Um, the only one left standing is the one for South Africa, and that's because of the large cap mining stocks, fundamentally. But there is a VanEck Africa ETF, which is really sensibly structured, which I've written about AFK. I mean, obviously it's deep value, but the opportunity in the long run is phenomenal. It's where all the population growth is coming from over the next several decades. You've got a huge percentage of global natural resources on that continent, and it's a kind of there's a sort of China derivative play here because you can sort of hitch a bit of a free ride on all of the One Belt One Road investment that China's been making in infrastructure and other aspects of the African economy, and I think that's a really interesting way to play it. Now um, there are some interesting offshore listed businesses that have direct interests in telecoms and e-commerce in Africa. I think those are interesting too, but that's a much higher risk proposition. A broad-based African ETF is something that you can probably camp out in a small way for the longer term. African equities, African credit, are at the very extreme end of the risk spectrum. So any kind of risk-off event, um, you know, those assets go no bid for a couple of weeks, but they typically recover quite quickly afterwards. It's just, it's something that you can only protect yourself with sizing.
Yeah, that's a great comment. By the way, of course, as we always say, and as you all know, this is investment thoughts and research, not investment advice. Only you can know your own risk. And as Rupert just mentioned, that is a little bit further out onto the risk
Oh,
curve. We have some
it's at
people
the very end.
at
It's
the
let's
very
let's
end,
let's
yes.
face it.
But we're talking about diversification, right? I mean,
Yes.
and as we look into 2025, a lot of people are trying to think about what that means in all sorts of ways, including geographically. You're long a lot of things. You're long more than you're short. Again, I think with a longer time horizon. We've got a couple questions about metals and how you feel about that. I don't know. Are you keen on metals? I think you were long
I
materials.
I always have positions in silver and gold. I don't have a position in copper currently, but I'm always copper curious. It's just been a terrible market to trade over the last few years. In terms of other commodities, you know I love the setup potentially in grains here right now in wheat and corn. It's been a terrible couple of years, and I confess I've been early and wrong on multiple occasions in the grain markets, and I've disqualified myself from writing about them for a year. But when pressed, yes, I'm still bullish.
Yeah,
Um,
listen, agriculture is a tough one. That agricultural
I tell you, but I
commodities.
do. I quite like the grain traders. I mean, we're waiting for this Bunge Viterra merger to close. Viterra being the Glencore's ag trading business, and I think that we've got potential for some significant weather volatility and geopolitical volatility. And if the merchants of grain can't make money in those kind of markets, I'd be absolutely staggered. So I do like the ADMs and the Bunjes as ways to play that. But it hasn't been a great run so far this year. We need that merger to close.
Yeah, you have to have some patience
And
on that one.
yeah,
So I'm going to close out with this one. Let's see. From Stephen, any EM markets besides China look interesting? We just touched on Africa. You may have been chatting amongst yourself and missed that, but any other EM that you're interested in?
I like Latin America. The Brazil chart looks horrible in dollars right now. But you know, one of the ways that people might want to think about looking at the EM opportunity is, there are some. If you like the idea of low duration, short duration, high yield, low valuation, have a look at the iShares Emerging Market Dividend (DVYE). You've got, if you look at the constituents there, you've got an average P of a forward P of 9.2 times. I think it's actually at the fund level, it's 6.7 times, 6.7 times at the fund level. And the underlying earnings for those constituents are still growing at 5% on a forward 2-year CAGR basis. Um, they're paying a punchy yield. I think the ETF yields 8.5%, 8.6% right now. And that yield is well covered. I mean, the free cash flow yield on the underlying companies is high single digits. And you know, that universe of underlying, I checked the other day, has $1 trillion of cash sitting on their balance sheets right now. I mean, so in aggregate, they've got cash to the tune of 34% of market cap. So you've got plenty of margin of error.
Yeah. Is it heavily
And
weighted China? Because that's one
no,
issue with
it's not. It's only a quarter China. So for
Oh,
people that have still got squeamishness about China, it's a quarter. And you've got 14% in ASEAN markets, a bit in India. Now, I'm not bullish on India. I think India looks really expensive to me right
mm,
now. It's where all of the EM managers have been hanging out for the past few years when they can't invest in China. But the kind of names, Indian names in there are sort of Indian Oil, Coal India, Vedanta, names like that. And then you've got a healthy slug of Latin American exposure, and it's mainly Brazil, but you've got some interesting sort of large caps out of Chile and Colombia in there as well as some interesting range in Eastern Europe. And we haven't even talked about Eastern Europe, and maybe that's
nor
food for
will we,
next time.
nor will we on this show. But this is the wonderful thing about your Substack and why I love it so much is because you do really sort of cross over so many different opportunities. I mean, your dashboard is huge. You're looking at lots of different things, lots of different assets, which I think is so interesting in this time. DVYE was the
Yes,
ticker he was just talking about, the
Delta
iShares
Victor.
Emerging Markets Dividend ETF. Again, not a recommendation. It's just something that is on Rupert's radar. This was such a fascinating conversation, Rupert. It was such a delight to have you on.
Thank you,
And
Maggie.
we only
Thank you for
just
having me
scratched the
on.
surface.
Listen, I like to think myself as the rodent equivalent of a Swiss Army penknife, right? I can be anywhere in any
Where did the
asset
blind
class.
squirrel handle come from?
Well, the old truism in the market, even a blind squirrel finds an acorn from time to time. Let's not forget, even Stan Druckenmiller's win rate is like 52%. Um, you
It's a
know,
hard game, but a
I
rewarding one.
Yeah, absolutely. Absolutely. Not going to be right all the time, but as long as you're structured appropriately, it shouldn't be too painful when you're wrong.
Fantastic stuff. Thank you so much. I love it. And thanks for the great questions in the chat. Appreciate it as always. We are going to be back on Friday with Brent Donnelly to dig in a little bit more about the dollar, which we're starting to hear a lot of people starting to agree with you. I shouldn't say a lot. A lot of the people we speak to starting to take a look at that dollar, Rupert, and wondering whether we're not going to get a big turn and maybe some intervention. So we'll
Well,
talk.
I think they want it. I think
Yeah,
they want it. They say they won't want it. It's sort of politically incorrect to ever deviate from, we want a strong dollar, but ultimately all their policy statements are pointing
seem
in
to
the
be pointing
direction
in
of a
that
weaker one.
direction. Absolutely. Yeah, it'll be interesting and an interesting BOJ meeting to chew over as well. So we'll do that. So
Oh yeah.
catch up with us then, everybody. You can find Rupert's work on Substack. We will put a link in the description. Join us there as well and make sure you subscribe to the channel. We appreciate all of you who did so far. We're rolling into that big number for year end. So help spread the word and get us there. Appreciate everybody. Thanks so much. We'll see you Friday. In the meantime, take care and good luck out there.
Thanks, Maggie.